My target would be that gold could be at 36,000 by 36. So in, let's say, in 10 years time, we could be like many times higher than where we are today, 20 times higher. Why? Because I think that we are moving into, as I said, the new inflationary environment. And I think we're going to see also that there'll be a lot of debt monetization and so on and so forth. But it still does not, again, there is a path to that. And I'm not sure the path is just straight up from here. And if you look at gold, you'll actually see that gold is up 50% from the 2011 highs, but you'll see that silver is down like 45%. The platinum is down like 45 or 40%, and gold miners are down like 40%, 43% from those highs. So we have to wonder, why is it that gold is taking off and all the others are not? And is it because gold is bubbling? Because everybody talks of it.
The speaker Henrik Zeberg predicts gold could reach $36,000 per ounce within a decade, driven by a shift into a new inflationary environment and significant debt monetization. However, they acknowledge the path won't be a straight rise. Gold is up 50% from its 2011 highs, while silver, platinum, and gold miners remain significantly below their peaks. This divergence raises the question of whether gold's current momentum indicates a bubble. Henrik Zeberg is a macroeconomist and market strategist known for his bold predictions and in-depth analysis of global economic trends. He explains the U.S. debt-to-GDP ratio has reached 203%, nearly double the levels of 2007 and 1929, both significant bubble periods. Valuations, including forward P/E ratios, are similarly inflated. The crypto market is booming with meme coins and thousands of new tokens, and Bitcoin is approaching $100,000. Meanwhile, the stock market has risen 750% since 2008, averaging a 16% annual return, fueling concerns about speculative excess. The speaker, Henrik Zeberg, predicts asset deflation will begin with declining stock valuations, though they remain bullish for now. They believe market tops were seen in July in major indices like the Nikkei and Nifty. As bubbles burst, recessions typically follow, leading to a broader price decline until the Fed intervenes. Moreover, the speaker Henrik Zeberg warns that if market declines continue, rising unemployment and banking issues could trigger a credit crunch, with banks recalling loans and financial institutions struggling or failing. They see early signs of this in Japan and expect it to spread globally, predicting significant financial stress by 2025. We're about to explore the video, but first subscribe and hit the bell icon to keep up with our newest uploads. Your feedback in the comments is always appreciated.
The market capitalization to GDP in the US, we are 203%. That is almost double what we had in 2007, double what we had in 1929, which were great or huge bubbles. And it was at 129 in 2000, which was a ridiculous big bubble where we did, .com, and it's 203% now. If you look at the price to earnings, it's the same thing. Even though it's forward price earnings, it's the same levels we're looking at. We have a crypto market where we see we see meme coins exploding higher. We have thousands and thousands of coins. Everybody seems to have the new idea about, why this is the best coin. We have, a Bitcoin at 100,000, and everybody seems to understand why that is the case. What I say is the case, and if you look at the stock market also, we are up 750% since 2008. That's a compounded annual rate of around 16% per year, every year. I think you're going to see that it will first come to the asset valuation. So first you're going to see stocks starting to decline. I'm not saying it right now, right here. This is we are in late November here, just so everybody understands that. I'm very bullish. I'm still risk on, so it's like that. But the moment when we see that the top here, which I think we have seen in the Nikkei in July, which I think we have seen in the Nifty, which are quite rather big markets, then you're going to see asset deflation first, so actually the value coming out of that. But that I always, like when we see a bubble to burst, carries on a recession with us. When you get a recession, you're going to see normal prices also coming down. So you are going to see a strong decline in prices for a certain amount of time until the moment when the Fed reacts. Obviously, if things are starting to decline, like what I'm suggesting here, you see that the consumer, and we're going to see a spike in unemployment. Banks are going to have a problem. And when banks have a problem, we know that there will be a credit decline and maybe even a credit crunch where banks will start to call in loans. We may even see financial institutions wobble and fail, and I think that is going to be the case. Actually, I think you actually have started to see some of that in Japan already, and I think that falling out has not stopped yet. I think we are at a pause from what we saw in August, but I think it's going to continue in Japan with the financial institutions there, and I think you're going to see that coming to the rest of the world also at a later stage. But even without that, I think you're going to see some of the financial institutions really, really not performing well, actually having a lot of problems going into 25. And that is a credit crunch, and that is where a lot of people feel the heat.
Henrik Zeberg notes that after 40 years of deflation, we're entering a long-term inflationary period. While short-term deflation may occur, inflation will rise steadily over the next 5 to 10 years. They suggest looking to the 1950s to 1970s for guidance rather than recent decades to understand this new economic path. The speaker, Henrik Zeberg, believes the recent DXY dollar index spike may mark a short-term top, with a potential drop below 100 ahead. This decline could fuel a risk-on environment. Capital inflows from other countries have driven the DXY's strength, and the resilience of risk assets despite this strength is notable. The speaker, Henrik Zeberg, foresees a deflationary bust fueled by massive debt, job losses, and a credit crunch, leading to widespread sell-offs in assets, including equities, crypto, and gold. They note that gold miners, for example GDX, GDXJ, have underperformed despite gold's highs, suggesting we're not yet in a sustained gold cycle. A strong US dollar, DXY at 120, and rising bond yields could further pressure gold. Now let's shift our attention towards the interview.
Now we are in new inflation. Does not mean short term, 1 year ahead, that we will not see deflation, as I say. But it says in the longer term, 5, 10 years out, we start going to see yields and inflation moving up and up. So we need to start learning from, not from what we saw in the 70s or in what we lost the last 10 years. We need to start learning from what we saw in the 1950s and 1960s and 1970s. That's the path we are embarking on, as I see it. And I actually think that was just a spike today, so I just checked it here. But I actually think that I think there probably will be a top end now, and I think we're going to see the Dixie.
Oh, we're at 107.5 actually.
Exactly.
Today.
Yeah. It's just a spike. But I think you're going to see that as a top, a short-term top now. Then you're going to see that you actually drop some just below 100. And on the Dixie, and I think that is going to power the whole risk-on environment. The Dixie has been extremely strong, and I think the reason it's been so strong is because you see the capital rotation from other countries, so capital coming in from other countries into the US, and that simply pushed the Dixie up. Yeah. And that has, the strength that we have seen in risk assets, despite that, has been quite remarkable. We are moving into a more uncertain world. We're moving into a world now where debt is, so big as it is. So I think it's good and fine. I hope the Danish Central Bank does the same. But I think it's not enough to withstand the kind of pressure we're going to see from a deflationary bust. If people are going to lose their jobs, if you're going to see a credit crunch, things will be sold off. Equities will be going to be sold off. Crypto, like annihilated, and gold is going to be sold off. And I think you will see that. And I think and again, we also have to look into the fact that gold miners have not done so well. Why is it that we see the GDX, the GDXJ have not performed so fantastically as gold has done? There's a reason for that, I think, and then maybe it has to do with that it's really not we're not in that cycle yet. For me, gold is actually, and I know this sounds crazy when you have a new all-time high, it's actually bouncing from a low. That's so I can show that on charts, and it's difficult to do here. But I think we're going to see that it's coming down rather strongly into that deflationary phase. And yeah, obviously there are buyers out there, but there will also be sellers. And credit crunch is not, and a Dixie at 120 will not be good for gold.
The speaker presents a complex outlook, predicting significant economic shifts over the next decade. While gold could soar to unprecedented levels due to inflation and debt monetization, the risk of a deflationary bust looms, with potential sell-offs across multiple asset classes. Rising unemployment, a credit crunch, and global financial instability could shape the near future, leaving central bank interventions as a critical factor. The resilience of the US dollar and risk assets amidst these pressures highlights the uncertainty of the path ahead. How might central banks' responses to inflation and deflation shape gold's trajectory over the next decade? What indicators should investors watch to anticipate a credit crunch and its impact on markets? We value your thoughts, so please share them in the comments. If you found this content valuable, please give it a thumbs up and remember to subscribe to stay informed. Thank you for being part of this journey with us.